So what the heck is going wrong with the financial stocks? What's going on with the financial sector, period? They keep announcing these great earnings, and then there is no reaction. Or actually, worse than that, the stocks just keep going down and down and down, and every financial analyst out there keeps telling you, buy the financials. They represent the best opportunity in the universe of stocks right now. They're undervalued. And then you hear them talk about the PE ratios, like that matters at all in the last 20 years of the stock market. Look, if you're a trader that is still looking at the PE ratios right there and you're wondering why your account is not growing, definitely subscribe to the channel, because here we keep it real. We tell you exactly when things go down, when things go up, and sometimes we're right 100% of the point, and sometimes we're wrong. I've never met anybody who was 100% right about any particular trade consistently over 100 different trades. So here's the deal. JP Morgan, considered to be one of the strongest stocks in the financials right now. What does it do today? Well, it made an effort to rally after beating the analyst expectations. It sort of did a poor job, just like it did 3 months ago. So the question of the day is this. Have the financials really gotten ahead of themselves when Trump became the president? I don't know how long you've been trading in financial markets, but when Trump became the president, the financial trade literally was an absolute gold mine. Because we take stocks like JP Morgan, Goldman Sachs, even the beat up Wells Fargo literally rallied. And the reason I know, because I had a position and it rallied. Wells Fargo within 72 hours after Trump was elected the president actually rallied from $45 all the way to $53. Now you're going to think, okay, what's the big deal? $8 move. Well, $8 move in Wells Fargo could take centuries. Hello? So if you're trading options, like that's a huge move for Wells Fargo, because I was buying these call options back then at 10 cents, and I was selling them at $4.50. That's a 4,500% return. So you're going to say, okay, well, what does this have to do with the financials, the way they're trading today? Well, I'll tell you exactly what. The market has overreacted when Trump became the president, because what did it mean to the financial sector? It became more deregulation, which was awesome for financials. Okay, it meant higher interest rates because he was already talking and debating about lowering, the taxes. So when you lower the taxes, typically you can't just have both fiscal and monetary policy going in the same direction. So if you're going to lower taxes, typically you see the interest rate spiking. But this is the very first time we actually see the lowest taxes and the lowest interest rates in the entire history of the United States. Now the question is, how the hell are they going to stimulate the economy going from here? Because they've used everything in the book at this point. And maybe this is why the financials are not reacting the way they should be. Maybe the investors are not 100% convinced that the rates are actually heading higher. Maybe we're fixing to go in a situation where you will see slower growth combined with higher inflation as far as the stock prices. Okay, and if he keeps announcing tariffs every other day, doesn't matter whether it's 25% or 10%, all that does, it translates into higher pricing on pretty much every product you buy here in the United States. So if the prices are going higher, the inflation is going higher. That's quite simple. If the economy is slowing, we're looking at a period of what I would call a stagflation. We have slower growth combined with higher pricing, and yet we have no signs of wages going higher. So if the wages are not going higher, look, let me ask you a simple question. Okay, let's say you're making $100,000 a year right now. Let's say you've been making that for the last 5 years. Are you going to go spend more? No, you would spend more if you saw your wages going up, let's say to $120,000, $130,000. And that's how the entire America is feeling right now. The wages have not gone up in a decade. The cost of tuition to college have gone up. The prices of everything that you buy here in the United States is fixing to skyrocket. So whatever your buying ability was, if a car payment of $700 was manageable before, guess what you're looking at now? It is no longer manageable. So as you know, the financials, okay, different banks focus on different things, but the bottom line, some of them are going to borrow some of their funds towards making auto loans. Some of them are going to focus on making real estate loans. Some of them are going to focus on, other investments. But the bottom line is, if the prices on everything keep going higher and your wages are not, what kind of situation are you going to be able to find yourself in? Especially when the majority of the population is yet again not learning lessons from 2008, and they are more maxed out on their household debt, including credit cards and student loans, than they have ever before. So I guess the humans remain to be the creatures of their habit. Nothing changes. The history keeps repeating itself. And if it does, then maybe when Trump was elected the president, when all the financials went rocketing higher, maybe we should at this point consider it an entire overreaction. And maybe the market are finally sobering up to the brutal reality of things. Then less people are going to be looking at the opportunity of taking out loans. Or if they are looking at taking out loans, then less people are going to be able to get approved because they're maxed out. And because of the inflation, your buying power is going to diminish. It's going to decrease. So no matter how you slice the pie, okay, the higher interest rates, if they do happen, does not necessarily equate to higher profitability to the banks. So you could have listened to every analyst on Wall Street saying, oh, banks are a bargain. Look at the PE. Who cares? Nobody cares about the PE. They certainly don't care about the PE. They may be telling you about the price-to-earning ratio, but it doesn't matter because what matters is what's coming next. If the prices keep going higher, less and less people are going to be able to get approved for the loan. If they make less loans, there's less revenue. And if people are tied up into barely managing their credit card payments, okay, who is saving? Nobody's saving because all the money that you're going to be receiving from your employer or your business, you're going to be using that towards paying off your bills. So that's why nobody's buying the financials, but nobody talks about it. And then you wonder why, okay, they're beating the earnings. Hello, okay, fiscal policy works temporarily. Yes, obviously, of course, they're making more money because they pay less in taxes. But how long does that last? Okay, that's not going to last very long. Look, guys, I don't care. You believe it or don't believe it. You're bull, you're bear. We're heading into some very serious, interesting time as far as the financial market's concerned. And I've been a bear for the last 8 months, and now I'm more bearish than ever because the stocks are trading their all-time highs. The great so-called financials are not rallying. And I typically don't trade the financial stocks from the standpoint of trading options because they're not very highly volatile type of product for trading options. But nonetheless, the lessons learned today on Friday, the 13th of July, 2018, are the following. Even the best stocks are what perceived to be the best stocks by the majority of analysts on Wall Street are not going higher on what is perceived to be great earnings. So what should we expect from the rest of the stocks that trade at much higher PE ratios? Okay, well, let's just take a complete look at what's actually taking place with the financial stocks today. And then we're going to be able to apply that pattern of what's going to be taking place over the next 2 months. So take a look at this graph very careful because this is actually the best graph of all the financial sector. JP Morgan. Okay, we've got diminishing RSI. We've got clearly a downward trend. The stock is trading under the 50-day line. We've got a lot of bearish signs. Yes, on the accumulation distribution, as they were saying for the last 3 months, buy. JP Morgan is the best stocks ever. What were they actually doing? Oh, surprise, surprise. all the investors, they were actually selling JP Morgan stock, which you can clearly see by this easy observation right there on the accumulation distribution line. Let's take a look further. Citigroup, death cross. Death cross is not a good thing. It don't even sound good, does it? Death cross. What the hell? Death cross? Whoa. Look, ever since the blue line here, which is the 50-day moving average, crossed the orange line, which is the 200-day moving average, the stock's been doing nothing but trending lower for now. I know a lot of the analysts are going to bring the low PE ratio. The PE ratio doesn't matter. If the sales of Citigroup drop, so will the stock. The profit margins are going to drop. Look, the future just does not look as good as all the analysts are portraying it to be. And what really matters is the action. So let's take a look at the accumulation distribution. Surprise, surprise. They're saying that's the stock to buy, while in reality they keep selling it. And this is exactly what we're seeing here again. So look, guys, if you're new to trading, sometimes things, when you look at stocks and their price action, it's just not what it seems to be. Sometimes when stocks actually go higher, like it did in this case right here, for example, in the case of Citigroup, see the stock clearly went from 67 to 71. Guess what they were doing? Oh boy. Nobody was very much interested in buying the stock, right? Not many takers. It certainly was much lower. Look where the accumulation distribution was right here at the same price level at 71 before. It was all the way up here. Now it's here. So the stock price keeps rallying. What they're really doing is they're selling the stock. Now, you wouldn't be able to just make that observation, but just observing the price action alone. Let's take a further look here. Wells Fargo. You're going to say, okay, Wells Fargo is a dog. They got all kinds of issues. Okay, sure, fine. But from the standpoint, if you listen to the analysts, right, the PE ratio matters. No, it doesn't. Nobody cares about that anymore. Okay, so here's what you got. They keep saying it's a deal. It's a deal of the century. It's a deal of your lifetime. Buy Wells Fargo. Well, I don't think so. That's not what they're doing, right? Certainly, as the price rallies from roughly this 50 range right here to all the way to 55, 57, are the financial investors, are the investment banks really buying this stock? No, clearly no. And look what they did today. They sold. They not just they sold, but they sold in very high volume. Let's take a closer look at Capital One Financial. You're going to say, well, that's not even financial. Most of their business comes from credit cards. Okay, fine. So I wanted to add a little diversity here. So this particular stock just running into a death cross. It's about to face the reality of what the other financial stocks have been facing for the last few months. And look, charts don't lie. Look at this. How many times has this poor little thing been trying to break out higher? Look at all these black candles. Talking about death cross and black candles. Does it get any worse than this? To me as a trader, it certainly doesn't. It clearly sends a lot of bearish signals to me that this move lower is not done with the financials, because as positive as the news were today, as positive as the news were 3 months ago, these stocks are not heading higher. But what's more important, it's not the financial sector that's not heading higher, since they're the first ones to actually report the earnings. It's the other stocks that we're able to observe the trading behavior during the earnings seasons that we're going to be able to place some magnificent trades. And in this particular case, to me, financials not going higher today clearly represents technology stocks are not going to be heading higher either. You know, other sectors, no matter how good their earnings are, if you look at the history and what's taken place 3 months ago, besides maybe just a handful of stocks, which you may be able to just handpick, or you may be just able to guess them. But generally speaking, if we're talking about a predominant move in the stock market, you will see this earnings season again, stocks moving higher. And yet, as soon as the market opens, they will sell off. That is, again, the predominant market move that I am observing. And speaking of which, I sent out the alert earlier this morning on Goldman Sachs. It is going to report earnings on Monday, and guess what's going to take place? It does not matter whether Goldman Sachs is going to report great earnings or poor earnings. What matters is how will the market react to the earnings of Goldman Sachs. And to me, this chart right here speaks nothing but the truth. And every time Goldman Sachs rallied higher, it was a great opportunity to short. And I don't believe this time is going to be any different. Look, it drops lower, goes higher, perfect time to short. Death cross, goes lower, rallies higher, black candle, black candle. All the bearish signs are here. Drops lower. Now it just slightly moved higher. Close to $126.41. Look, next week, my projection for Goldman Sachs is going to be trading around $214, maybe even $210 a share. And how am I arriving at this crazy estimate? Well, when Donald Trump became a president, Goldman Sachs actually rallied all the way from the 150s, 160 to 200 very, very fast. From there, it sort of traded in the side range for a little bit, and then it regained a level of $210 and rallied from there on. Well, it's clear to me now that it is revisiting that level of support. And a move from $226 all the way to $214 or even $210 is not going to be something totally out of sci-fi movie. That's actually going to take place. As you can see, nobody's buying the stock. Every time it goes higher, you see nobody's buying it. Right here, look at the accumulation distribution. Nobody is interested. Nobody cares about the PE, so stop listening to all those crazy things when you're listening to the news. And here's the blank slide right here to leave you with some food for thought. If nobody is actually buying the financial stocks, which are currently debated as the best values in the stock market, what type of pattern do you think you will notice when the rest of the good stocks are going to be reporting earnings? If the stocks that are beating the earnings analysts' estimations cannot rally, what do you think to the stocks that are barely going to match them? What do you think is going to happen to the stocks that are slightly going to outperform them? Well, the answer is, I don't think they got a shot to rally. So the predominant market move is going to be when stocks go higher, get brave and short them. No matter how green your screen may look, it is time to short. The market is at its all-time high. And just as it appears to look like, it just gonna keep going higher. Sure, Amazon can rally for another day or two, but it's gonna go down with the rest of the market. We're that close to a reversal. So this is not the time to buy calls. This is not the time to go long. This is the absolutely best opportunity to short the markets, and we should feel privileged that we're even get to leave for this historic event when the stocks are trading at their all-time highs, when Amazon is at $1,800, when Google is at $1,210, when Tesla, is still over $300. Thank you, Mr. Market, for providing us with such phenomenal opportunities to short what appears to be the most bullish market in the history. We're not blind. We see the signs, and we're going to take the appropriate action. If you'd like to know what my next trade is, simply click the link below, subscribe to the channel, subscribe to the alerts, subscribe to the multiple courses I've put together that has helped me put numerous trades together over the last 12 years that consistently generate 300-400% returns. And yes, I'm not correct on every trade, but I'm pretty damn good at it. So if you'd like to learn more, check out the links below to your trading success. I'll catch you in the next video.